If you're still losing trades, struggling to become a profitable trader, it's important that you understand this. You don't lose trades because you have a bad strategy, and you don't lose trades because you're just unlucky. For the most part, you lose trades because you constantly get caught on the wrong side of the market. It's very simple. When price wants to trade lower, for some reason you get caught buying. When price wants to trade higher, you for some reason get caught selling. And in this video, I want to simply solve that problem for you once and for all. Getting the direction right literally solves 90% of profitability when it comes to trading. And so in this video, I want to reveal to you 3 very important things. The first being how to actually understand market structure. The first is why being on the right side of the market literally solves 90% of your problem. And so in this video, that's exactly what I want to do. I want to give you the 3 most important things that will enable you to get the directional bias right consistently. And the first thing that I want to explain to you is why most traders get structure wrong in the first place. The second is what actually matters when it comes to deciding on your bias. And finally, how you can automate market structure so that you don't even have to think about it and completely eliminate guesswork. Now, let me show you exactly what it is that I mean. Now, look at this chart right here. We're on euro-dollar 15-minute time frame. And this one piece of price action could be perceived in so many different ways. Not to mention the sheer amount of traders that are interpreting this in a completely different way. On one hand, you could be zoomed out and you could be looking at, we're clearly in a bearish trend. Maybe you're looking at something like lows down here, highs up here, lower low, and then we shift to bullish up here, right? Higher high, and then we go lower low, and then lower high, and now you're expecting these lows to get played out, right? That's one angle that you could look at. Another angle is you could end up coming super zoomed in, ignoring everything that's happened on the left, and you would just be kind of fixated on this and here. And maybe you look at this and you're like, okay, well, we were in a downtrend and now we're in an uptrend, right? And that's our structure leg. Someone else may look at this was a shift to go to bullish, right? And now we're in this type of uptrend. And if this changes, now we're bearish again. And so the big question is how do you actually mark out the highs and lows? How do you know if something is actually a pullback? This is the one thing to solve with market structure. It's plain and simple. Everyone can tell you, and I've made so many videos on market structure that have got hundreds of thousands of views, and yet still people cannot read market structure. Because in theory, it's easy, right? I could sit here and I could pull up a chart like this and I could tell you, we're in an uptrend. Obviously, you want to be trying to buy the lows and get out of the highs, right? It's very, very simple in practice, right? This is a downtrend. We want to sell this high and get out the market at the lows. Even if you make it a little bit more realistic, like let's say, this is your actual structure and this is internal structure, and you want to be focused on the external swing points, right? Which is how price usually looks. This is all theoretical. The thing that I keep see happening is that you get this information and then you come to a chart like this and it all just goes out the window because you don't know which high and which low to use, like what actually makes a high and a low. And that's the thing. It's not that you don't know market structure. You do know market structure. You understand what a break is, right? You understand that when a high gets taken, it's a break. You understand what a change of character is. You know logically that when price goes from being bullish to bearish, that's a change of character, right? You know these things. You know when a change of character occurs. You know when a break of structure occurs. Your issue is you don't know if they're the right ones. That's simple. You don't know, are you marking the right break of structure? Is that actually the break of structure? What if this isn't the high? What if it's this high? What if it's this high in here? What if it's this high? Because the thing is any one of them could be a break of structure or a change of character. But the difference between real consistency and being accurate and being on the right side of the market time and time again is which high and which low it is that you choose. And that's the real issue that you need to solve. And once you solve that, that's when you'll be able to unlock consistency. At least that's what it was for me anyway. I spent so long trying to master market structure, and it was a love-hate relationship because I knew that market structure was the thing that was going to make me profitable because it so clearly gives you a bias consistently. Without it, you don't even really have an idea of what direction to trade into. You have a bunch of random concepts, but no backbone of direction, which is the most important part. But at the same time, I was getting lost and confused over and over and over again on what actually makes a high and what actually makes a low. And that's what the problem was for me, again, for the longest period of time. Let's take something like this, for example, right? Again, it's the same as what I just spoke about. You might start with a high, you might start with the low, but look, this is one price leg, and you could read this in so many different ways. And here's the key part. This is what I was making mistakes with, is this would be the price action for 1 week. And at the end of it, I would maybe come out with the conclusion that we are actually bullish, right? On a different week, I could see the same price action or very similar type of price action, but actually perceive that price was bearish. And the problem with that is that if your framework for directional bias is so inconsistent, you're ultimately just gambling, because each day that you're coming into the market, you're just kind of hoping that your direction is correct. And so if you have a completely unstable foundation, if you're guessing on your direction, then nothing else matters. You can understand liquidity and order blocks and fair value gaps or all of these other concepts, volume profile, whatever it may be. But if you don't have a proven, repeatable framework for consistently getting the direction right, none of it matters. If we are bullish, right? If price is going to trade higher, the best fair value gap after a external range manipulation and it isn't going to work, because nothing can outdo the order flow. Nothing can outdo the direction. And yet you might perceive this as bullish right now, right? Maybe you had something like this. Maybe that's you. And then maybe on a different day, let's say you get price action like this, right? Price comes down, takes out this low in here. I mean, how many times have you found yourself in situations where this is the situation that you're in? Again, one week you might look at this and you'd be like, okay, well, we're bullish, you know? Oh, maybe that's an inducement, try to take longs from here, something like that. And then in a different market environment, you might look at this and you might go, oh, actually, you know what? Okay, we were bullish, but we took out this swing low down here. Maybe it looks a little bit more attractive, right? We took out this swing low down here and there's a really nice fair value gap here. And, you know, maybe that's the level. If that's what happens to you, that's why you can't get consistency, because it changes. And this is what I figured out. And from there, it sent me down a rabbit hole of going and exploring what actually works for market structure. And so I went and I tested so many different things over so many different periods of time. And I tried multiple different rules, right? I tried specific percentage pullbacks in the Fibonacci retracement. Because what you want to do is you want to try to find a framework that you can repeatably use that tells you consistently whether something is a pullback. And I tried all these different things over many different years of data. And eventually, most of the things worked, but one thing worked incredibly well. And so that one thing, I took it and I taught it to my inner circle members. And it worked great. Like, it helped so many people and transformed so many traders. And yet still, even though you have the exact framework that I use, there were still people coming out and they were like, just had the doubt, because they have to manually do it themselves, and constantly posting and having doubt of like, hey, you know, I understand the structure rule. I think it makes sense, but I don't know if I'm right. Can someone please check it? Or plain and simple, they're coming out and they're like, I understand the rule logically, but I don't know, is this the high? Is this the high? Like, how far back to it? Like, all these questions, and they still had doubt. And so even though they had a rule, they were still getting it wrong. They were still getting on the wrong side of the market, and they still didn't understand it, even though I had already solved the issue for them. Now, of course, not every trader went through this. There were traders that took the rule and were able to consistently produce the results. But then another element slips in, which is human error. Simple human error. So we go back to price action in here. With the rule that I had, or that I still have, I still use the rule. You can sometimes, if you zoom in too much to current price action, or if you end up in a large range, right? Like, this is a very large M15 sideways range. Price isn't usually always like this. A lot of the times you might get this type of price action where price is kind of really just delivering in a trending fashion. But then once you get this, like, look at this, that's just a pure range. If you go to a higher time frame, euro dollar has just been in a crazy range. It's very difficult in that environment to every single day have to come in and look through historical price action to make sure that you're following the rules. And what's happened, even to myself, genuinely myself, I've missed out on trades or taken trades that I shouldn't have taken and lost money because there were things that I missed in my own rule, because there are elements of human error. I have to take my time to go and measure this specific rule that I have in place to make sure that something is a high and something is a low. Take this price action here, for example, right? Again, there are so many different ideas of what some people could have. Like, one person might have swing structure like this, which I used to read swing structure like this, and you're expecting, you know, lower prices. One person may have it like this, where they're literally looking and zooming in on price, and they're like, okay, I can see we're bullish, right? We had this in here to this high. And maybe some people are like, now this is their new structure and price is kind of playing out. And now they're like, okay, well, now price is bullish. Okay, well, now price is bearish. We've taken this low. We've taken this low down here, and this low's gone. So there's a lot of people that are probably looking at this right now as though it's bearish, and it plays out really nicely. And okay, now it's continuing to perceive it's bearish. And then some people are like, oh wait, maybe we've just shifted bullish. Like, there's so many different ways that you could reach structure. That's the point. Ranging out in here. And now price again starts having this kind of dramatic sell-off. And again, at this point, like, so many traders are, again, same thing, looking at this like this is bearish price action. And maybe some people see it differently. But what I decided to do is I took the rules that I had that are tested over many different years with a very high degree of accuracy, and put them into an automated system. That's what I wanted to show with you. That's what I was talking about when I said that we can automate structure. Like no longer do you have to think about structure. You can automate it. Just take the rules. And again, you don't have to use my one specifically. I've created one that I first wanted to use for myself specifically to eliminate the guesswork, to eliminate human error, to make it so that I can just click the button, come into my session and understand my bias without having to go and do it myself. And I've been using this now for myself personally for a while. And then my inner circle students seen it and they also were like, can we get access to that? And so then we rolled it out with those guys as well and they used it as well. And then one of the members of the team had the idea, like, why don't we run this out to the general public? Like there are so many people on your YouTube channel that you've taught market structure to that still don't understand market structure, that probably can't afford the thousands of dollars that it costs to be inside of your inner circle program, but would benefit so much from an indicator like this. And so that's what we decided to do. We decided to run it out to the public, to you guys. And again, if you want to check out the indicator, I'm going to walk through more on it now to understand it. But again, I'll leave the link in the description. You can go and kind of take a look at it for yourself. But literally within a click of a button, I can click this and it already tells me. I see here the H4 is bearish, right? And I can make this larger if you'd prefer. Okay, the weekly is bearish, and this is directional bias. This isn't even related to market structure. This comes with it. It's a different segment, but just look at market structure for a second. The H4 is bearish, but the M15 is bullish, and I use the M15 as my predominant bias. And it tells me this is a break of structure. This is my change of character. And it also tells me, if you look in here, I can see internal structure, right? Internal lower high, internal break of structure, internal break of structure, internal break of structure, internal lower high, internal lower high. It tells me the highs and lows. I know that this is a swing high. I know that this is a lower low. I know that this was a break of structure. This was a change of character. So we were bearish, right? And here's a perfect example of how having something like this is a lifesaver. Me and the members caught a really nice trade here on the 18th of March, and we wouldn't have been able to catch it if it wasn't for the indicator, because many people would perceive that this is ultimately shifted bullish, right? Because what happens is we were bullish and we shifted bearish. You can see here, change of character. We take the lows and then we have a higher high, and then that high gets taken out, but it only gets wicked. And because it's only wicked and doesn't break, it doesn't give a change of character, as you'll notice. And so after this wick and the aggressive reaction out, we actually ended up taking really nice short positions in here. And again, that's a break of structure. That's a break of structure. So for a while, the play was short, continuously shorts. And again, even in here, Thursday, 19th of March, again, we have a 2.0 model. This was shorts in here because it tells us in the morning what direction of the market we're trading. And now, even in this, even though many people may perceive it as different things, it tells me it's bullish. And so I already know what I'm expecting. And that is higher prices, right? Plain and simple. We was expecting higher prices from the beginning. And then you can start tailoring in your other things like, okay, this is a manipulation. This is the initiation. So this is the obvious area of demand, right? And then even framing trade ideas based off the back of this. This is the area of demand. And again, this is more of a higher time frame kind of swing position, but still nonetheless. This was the area that we're expecting price to react from. We're expecting higher prices. This is the target, just in that from the indicator alone. And so it's coded specifically on the rule that I use to govern structure. And you can see it tells you the time frame. It works on anything as well. So I'm on the 5-minute time frame now. It will show me on the 5-minute time frame. It will show me the 1-minute time frame. I understand that the 1 minute shifted bearish down here. The 1 minute is the big thing for a lot of people, especially as someone who trades intraday on the 1 minute for my entries. It can become so noisy and it can like literally completely throw you off if you get the 1 minute structure wrong. It can completely throw you off. You think it's a time to get into a trade and it isn't a time to get into a trade. You don't think it's a time to get into a trade. It was time to get into a trade. You don't have to think about it anymore. You can click a button and it gives you your bias for you. And so, yeah, again, like I said, it's really important that you make sure, even if you don't use an indicator like this, make sure you have rules in place for market structure, because inconsistent framework to direct bias will lead directly to inconsistent results. It's like building a house on quicksand. It will just melt through. You need a solid foundation. And that foundation is market structure, as you know, which is why you're here. But that foundation, for it to be strong, has to be repeatable, has to be proven profitable. And so with that being said, I wish you the best.